Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. Oh my goodness, there are not enough superlatives in the dictionary to describe what happened today, not just today, but just what we've been going through in the financial markets from the last several days, last several weeks, with all of this economic warfare and the tariff chaos and the rolling crash in the stock market. And now today, an historic oversold bounds. I mean, there are just not enough words. So, what's going on right now is both simplistic to explain, but also very complex. So, bear with me if I bounce between both across this spectrum. So, what I want to start off by saying is something I've written about and also talked about in the video, which is the typical way that oversold works. The typical way reason why oversold works and why buying the dip works in severe market distress is that we usually have this kind of sequence, which is the markets whine and complain, the markets crash, they sell off hard. Then the policymakers in government panic. And then the policymakers, because they panic, they act. And they usually act in favor of the financial markets. And then the markets say, thank you very much. And the markets rejoice. That's the typical sequence. But what we saw this time around is that the policymakers did not respond until literally, I shouldn't say literally, until things got just so bad that they had to act. And yet, it's not quite that simple because what apparently happened today when the president announced a bunch of things related to tariffs. I think the main thing that the market's focused on is this 90-day pause on countries that have not retaliated against the US's tariff policy. Um, the market's fixated on that. It happened as the bond market sold off another day. And I'll get to that chart soon because it's very important. And it seems like, and of course, this is just speculating, that it was the bond market crashing meaning yields were spiking, that finally forced some sort of change. Now, I'm going to argue that this change is not meaningful because a pause is not a policy change. It's just giving the market time to digest what is coming. And I suspect in 90 days, and in fact, maybe even sooner, because as we've seen, the policy has changed almost on a dime from day to day and week to week. So the reason why I say fundamentally nothing has changed because we have seen and policymakers have proven that things can change, people's minds can change on a dime, almost on a whim. So let's see what happens. Let's go through the charts and really get a good understanding of what's going on. So again, this is the heat map. It shows pretty much everything in the market was up today. The big cap tech stocks came back with a vengeance. This is scaled, of course, by market cap. So you can see some of our biggest companies put on double digit gains, just unprecedented trillions and trillions of dollars exchange hands today, just like in the crash that we had preceding this. Okay, let's timestamp this with Yahoo Finance so you can see some of the big headlines. The biggest one, of course, is stock stage wild rally. You can look at the intraday move here. Someone got the drop early in the day because we were down for a little bit, I think, and then immediately shot up. But the news didn't really drop until right around here, I believe. It was about maybe 30 to 45 minutes into trading. Um, so you could see here this headline, the worst case scenario is off the table. So for the stock market, this is something for us to understand too, in terms of we can't be too wedded to cause and effect, meaning that we wait for the good thing to happen before we buy into market distress and panic. What all that's happened here is the market's relief is that the worst case scenario is off the table, even if the policies eventually are going to be exactly what has been said coming into today. The worst case scenario is off the table. I suspect the worst case scenario is probably people panicking about depression level type economy, maybe even a recession or some other kind of calamity. So for now, let's assume that that's off the table in terms of market sentiment. That doesn't mean that those things can't or won't happen, but all we're concerned about is what does the market think and how should we react to what the market thinks. Okay, so you will see some other interesting headlines that deserve some more digging into. And I heard some of this listening or watching CNBC. For instance, here, apparently President Trump on his social media outlet made a recommendation, said that this is a good time to buy stocks before he announced the tariff pause. Trust me, I don't care where the political spectrum you're on. This is going to cause a big firestorm and a scandal. I mean, I know nothing's going to happen of it because we've already had moments like this where there's a lot of fuss and nothing happens at the end of the day. But this is something that we as investors really need to take note of because it means, again, that we can never be on sure ground with our trades if even our policymakers are putting out little tidbits here and there for certain folks to grab a hold onto. So anyway, I'm just going to leave it there. Um, this tariff pause, what I'm calling sort of a tariff blink, is a tariff blink because, all along until the very moment that we heard about this pause, it seemed like our policymakers were actually digging in their heels deeper and deeper and deeper and deeper and becoming more and more and more stubborn. That's why the market had to keep whining louder and louder and louder and selling off harder. Okay. All right. So let's take a look at more headlines here. I hope there's some good ones because I've been hearing a lot of great stuff today. Here we go. S&P 500 has its best day since 2008. Um, this is something that again is going to now get back on market radar, which is the March CPI report. This is something I agree with. I've been arguing for a long time that inflation was going to remain sticky. So this is something that in a bad inflation report can turn the market over right on a dime. Let's see here. We have wild swing in treasuries have investors worried about blow up. So this is the thing that caught, I think, our president's interest. CNBC reported, and I still need to go and see confirmation of this on video, but CNBC claimed that Trump, in explaining why he put on this pause, is that he was watching the bond market. Okay, that's understandable. Again, remember my narrative: markets panic, then the policymakers panic, then the policymakers act, and then the markets rejoice. Trump watching the bond market and deciding to change his mind makes sense. But then the other thing that was curious is that he said he was watching Jamie Dimon of JP Morgan. I'm a holder of JP Morgan shares and a call spread for a short-term trade. So, kind of heartens me to know that Jamie Dimon is helping to move policy, helping to move markets. So the next time financials sell off, you can trust I'm going straight to JP Morgan to buy shares. So again, that's another little tidbit, little breadcrumb that's been dropped out there for us to pay attention to. Okay, enough of the headlines. Let's look at the charts. Okay, my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I call AT50 for above the 50. For all of the big gains today, we were so oversold that even moving from off of 5.5%, we are only about halfway there, maybe less than halfway there to ending what is now a 5-day oversold period. Okay, so the message here is we are still oversold, which means that technically there is still some upside, actually plenty of upside if we're actually going to get a rally all the way back to overbought levels. But at least for this oversold period, we still have a little bit of more upside to squeeze out. Let's look at AT200, which is above the 200. This is really great news. We came off of multi-year lows. I believe this is multi-year lows, and now we're at a high for the last 4 trading days. Look at this massive move, 9 percentage points, which translate into a 60% change. So as I argued earlier, when I first pointed out the oversold, what I thought would be a washout, and then on Monday, what looked like bearish engulfing, these kind of big moves on the heels of a big drop are actually really important to pay attention to. So this is more confirmation. Now let's move on to the indices. So we have the S&P 500. This is the crazy thing here, which is the S&P 500 soared and rallied 9.5%. In fact, this rally was so strong, it wiped out a lot of the last losses, and we're right back to the bottom of what I call the first area of agitation. I mean, this is just a historic move. Now we only have to worry about the 20-day moving average as the next resistance level. It happens to converge with this low as resistance level. So let's watch that. The upside gain, again, is going to be very small relative to what happened to today. So this is not a call for chasing. It's not a call for taking extra risk. You really needed to have been trading the panic earlier than this. And in my previous video and previous blog post, I talked about how to play things if you happen to miss the big move off of an oversold low. So anyway, let's go to the NASDAQ. The NASDAQ also historic move. It's ended its conventional bear market, which is 20% off the all-time highs. That's a positive. It's 12.2% rally, took it all the way to the 20-day moving average resistance. So this is going to be important to watch. You can see the NASDAQ was able to break out above that briefly before selling commenced. And then even after that, look at the converged resistance from the 200-day moving average, which is the blue line, and the red 50-day moving average. That's going to be really, really tough resistance to break, assuming the NASDAQ gets there in due time. And then we have IWM, which is the ETF of small caps, the iShares Russell 2000 ETF. It traveled, essentially, it's now traveled all the way from close to pre-pandemic high, all the way back to its bear market line. So expect a challenge of that resistance coming soon. It's kind of ironic that small caps, as speculative as they are, were actually the laggard, only, quote unquote, only 8.5% gain on the day. Now, most importantly, the VIX, the volatility index. This is what I really wanted to see to finally confirm a bottom. Sorry, not a bottom, a sustainable low. Again, the difference is sustainable low means that price will be above that price point for some short-term amount of time, but the bottom is not something we can know until we have enough hindsight. So you never try to predict the bottom. You try to do your best to play a sustainable low, but that's the way it just shakes out. Look at this massive plunge in the VIX, 35%, 36% plunge, essentially wiped out a lot of fear, this was our first indication that fear was exhausting itself. Yesterday, the VIX rebounded after the US retaliated against China's retaliation. So it kind of erased what was building out to be a great follow through. Now we've got our big follow through in massive form. Let's look at the VXX, which is a way to short volatility if you buy puts, which is what I have. And you can see it dropped 20%, 21%. And in the after hours, it's dropping further. I held on to my put options on VXX, so they don't expire till next Friday. It's also a good way to hedge against other options, call options that I have as well. Okay, so those are all of the major indices. Let's take a look at the bond market. And the bond market, like I said, was probably the biggest concern for our policymakers. It gapped down below. They have been talking about the importance of getting long-term interest rates down, and that's the exact opposite was happening these last 3 days. And you can see now yields, well, the price of bonds has gone back up, and interest rates have come down. So fully expect that the policymakers will still talk a good game to get this. This is TLT, which is a good proxy for long-term bonds, to get this to start climbing back up to where it was when they were really, really happy and feeling like policy was working. So these are the dynamics for traders to watch out for. Hopefully you were paying attention to the extremes in the stock market, didn't get carried away trying to short or bet against this market. Very dangerous to do in oversold territory. What I did is this rally was so crazy strong. I mean, some of the holdings, the trades that I talked about earlier that I was going to make, most of them gained so much today that it was essentially a year's worth of gains in one day. I had to take those profits. There's just no way, even with me expecting further smaller gains ahead, there's just no way I can leave those kind of gains on the table. Okay, so let's wrap this up with one stock. I'm going to write about this in my blog because I think Delta reported earnings, and there's some important lessons in the transcript. I'll just say that Delta had a huge challenge, which is, you know, this they had given an earnings warning right here, which further confirmed the 200-day moving average breakdown. It caused a lot of stir. Um, Sorry, let me get my cursor back here. The Delta lost 7%, 7.3%. So, of course, there's an expectation that Delta is going to have bad earnings. Well, look what happened. I mean, of course, this is supported by the day's big rally, but instead of selling off further, Delta actually rallied 23.4%. What is the lesson here? Is that at some point, all the sellers are washed out. All the bad news has been anticipated, and all that's left are the people who want to keep holding onto a stock. And so, who comes to fill the vacuum? It's buyers. And in this case, the buyers decided to say, hey, we think Delta Airlines has gotten about as bad as it can get. Remember, worst case scenario off the table. That's what the market is saying about Delta. We don't know whether that's true, but we do know that that's what the market is saying to us. Delta rallied right to 20-day moving average resistance, so that still a proof point for the buyers. And something that the CEO said, or that was reported that he said, I'm going to go to the transcript later to get more context, is that they took guidance off the table. That's fully understandable with all the economic uncertainty going on. But he also said that recession, he couldn't speak on whether there was a recession, but he did speak on how strong the business uh, is still is. Not as strong as it was last year, a year ago, but it's still looking strong. So all that to say is Delta is a great lesson in not overplaying the hand on looking backwards. You have to consider the forward-looking potentials and scenarios. Now, I'll just end with this economic. Also, finally, we're going now from the news headlines to technicals to trading lessons. Now, let's take a quick economic lesson here. This is just one sliver of all the economic chaos and news that's going on. I took a quick look because someone claimed that there are all these manufacturing job openings still out there. And so I took a look for myself. I always like to confirm. And lo and behold, I went to Fred, which is a good source for a lot of economic data. The Federal Reserve Bank of St. Louis publishes this from different sources. And you can see here this is the total job openings in the US on a monthly basis. And the last time it was updated was April 1st, and it produced February data of 482,000 job openings in manufacturing. If you look at some of the things that are being said out there, you think that there were zero manufacturing jobs to be had in the US. And in fact, not only are there plenty of jobs to be had, but we are at a level where job openings peaked for manufacturing during in November 2018, and then they proceeded to decline because the economy was weakening into the pandemic at that time. And this is why we lost a lot of manufacturing job openings. They soared again post-pandemic. We all know what happened then. Federal Reserve was working together with the government to prime the economy, doing a lot of fiscal and monetary stimulus, and boom, we went up. So of course, this is an overheated condition in terms of all these job openings relative to people who are available and willing to take jobs. So now these job openings are coming back down. But this is not a bad thing. It just means that this is actually a good thing. It means that a lot of people are getting hired. It's not really a bad thing until job openings, say, go down to maybe this level, which was the economic slowdown that we had going into the pandemic. I won't go into all the details of that slowdown because a lot of people probably missed that. All that to say is that this is context for what I was seeing going into today is that there were a lot of people trying to speak truth into economic principles. And we had libertarians, we had constitutional conservatives. I think that's what they call themselves. And then we had moderates, all kind of saying different flavors of the same thing, which is this tariff chaos just didn't make sense in total. This is not a political statement. This is just a economic reality. In fact, I'll just name the person, a Republican Senator Rand Paul. I think he's actually a libertarian. Said the reason why he was speaking up is because he wanted to speak to truth and facts, regardless of the noise around him. And I really admired that. And I think this is a time for us to help people with clarity on what the data actually say so that you have the proper context on what's going on with policy. So let's just wrap this up by saying that continue. I think there's many things to watch out for, but one of the things that's important to look out for, and I'll go back to the headlines to close this out, is what are the different voices and who are those voices? What credibility and expertise do they really have? And what you're seeing is a lot of the credible expert voices have all been singing the same song, which of course aligns with all of the panic that was going on in the financial markets. And so again, we had the result that we typically see in oversold, distressed market periods, which is, what is it again? Let's review one last time. The markets complain, they whine, they panic. Then the policymakers panic because they care more, oftentimes more than individuals panicking. They care more about markets panicking than individuals panicking. Then once the policymakers are finally panicking, the policymakers finally act, and then the markets rejoice. So that is the theme for today. Markets rejoice. The tariffs, we got a tariff blink, and here we are with a massive historic update. Okay, thanks for checking me out. Again, like, share this content. If you have any questions or feedback, put them in the comments. You can subscribe to this channel for more videos like this, or go to my blog at drduru.com/122 for more details. Thanks, and talk to you later.